I see a thumbs up. Perfect. All right. Okay, let's start off with Marc. Do you want to give a little introduction of who you are, how you got into investing, and what your fund focuses on?
Yes, I'll do the quick background almost from day one. I was a maths undergrad a long time ago. I was an interest rate swap trader at banks for 7 years. 2001, I quit and did a master's in AI. There wasn't much around then, but turns out to have been a good decision, although I can't claim any great prescience or expectation of what's happened now. I went back into the city. I joined a small proprietary trading group, and I built the systematic trading arm of that up from scratch to become most of that business. I'd been doing a poker and AI side project and brought my friend I was doing that with into the trading business, and we built the fully AI version. I was doing that up until about 5 or so years ago when I moved to Guernsey, where I live with my wife and 4 sons. Started doing some angel investing and got invited to be advisor and then partner at a small VC out here. And about 10 months ago, struck out on my own. And it's actually just my capital that I'm investing. So I'm quite small fry, but I'm pretty disciplined, very focused on making sure I've got the right process to be able to make good decisions, and also making sure I've got the right deal flow to be able to choose from. And I invest in early stage pre-series A digital tech businesses. I try not to have a much broader thesis than that, because sometimes the most interesting things aren't interesting until you hear them in the words of the founders. So the most unique thing about my process is actually I don't want you to send me a pitch deck. You go onto my website, you record a short video, and that's my filter for taking a meeting, because I think that's much more, someone's ability to do that well is much more highly correlated with their sort of founder skill that I'm looking for than a pitch deck is.
Perfect. That's a great lead into my first question, which is how to make a good first impression with investors. Before that, though, I'll just say, founders, if you have any questions, put them in the chat. Raise your hand for the live Q&A bit. You guys know the drill. But yes, Marc. Okay, what's the best way? Let's do in the video. What's the way to captivate investors' interest? But also, if they were to just send a pitch deck or an email, what's going to grab your attention?
Yeah, I think the more general, I can tell what for me, and I think the more general answer is more useful, because I'm one of many people out there, right? And you need to be able to do it for everybody. But the reason I do it that way, and I think this does transfer into pitch deck or into bullet points or email, is you need to be able to tell your story concisely and compellingly, right? And it is a story rather than a list of facts. And the reason it's those two things, for me at least, is compellingly is actually quite strongly correlated with a sales skill, right? And a sales skill is one of the key skills that I look for and that lots of people look for in founders. You need to be able to sell, both to be able to sell, to be able to raise, and to persuade people that probably shouldn't come and work for you, that they want to come and work for you. Concisely, actually, if you can explain things concisely, that means you understand them. If you don't, even if you've got quite a complex business, and obviously it's easier for some businesses than for others, but if you can explain it concisely, that means that actually you understand it well, and the risk is that you don't. So those are the things that I think I'm looking for, and more generally people are looking for, and why. In terms of red flags, I would say if you're in a highly competitive area and there's no clear signs of differentiation, then that for me is a red flag. And again, sort of back to the original point, if you're not able to, if you've got a poor ability to express sort of what and why, that's not a good sign, and I might then not go to the next stage.
All right. And what about the red flags that come in when people are sending in their pitch decks or the videos? You named a few of them, but do you want to expand on that?
Yeah, I mean, it's kind of more the same. I'm looking for that sales skill, and if I don't kind of feel it, and not every founder has to have that. Like, so if you've got 2 or 3 founders, really only one of the founders needs to have that specific skill, but that's absolutely key. I think it is those same things. If it's one where I've seen like 10 other things that look the same of it, in the last like 3 months or 6 months, and I don't see everything, you're probably in quite a hard space. The other I'd say the other one that I didn't mention is something which sort of Y Combinator calls the tar pit idea, which is one where everyone goes, oh yeah, that's a great idea, right? Any idea that's sort of too obviously a good idea means that lots of people have thought about it before, and there's probably a strong reason why it doesn't work and it's going to fail. And so sometimes the ones with the more everyone goes, yes, that's a good idea on day one, that can often be a poor sign.
And how much of that storytelling and um I guess like the selling bit of the pitch, how much of that is down to numbers if they've already launched or engagement, and how much is that down to let's say kind of like the more qualitative side of the business and the particular like storytelling aspect?
So I think you're looking for both. In terms of the founder skill, it's all about how you tell it, right? Whether you've got a good story, whether there's a real thing there or not, it's about how you sell it. And you're trying to, at least I'm trying to, listen through the words for the person and their experiences, to look for sales skill, to look for something that shows me you're going to be a really good decision maker, something that, if possible, evidences that you've got sort of resilience and tenacity. And those latter two are quite hard actually to figure out, if I'm honest, but those are other things that you're looking for. Of course, the numbers matter, but that's more on the business side rather than on the founder side, and they're both important.
Makes sense. When it comes down to, let's say that you get that pitch, it's very interesting. You want to have that first meeting with them. What sort of questions are you asking them? And then also, how do you, for companies where you've seen a lot of competitors in the space, or maybe you've received a pitch with a similar idea before, what are you really looking at to assess whether they are different and are compelling?
So because I'm looking for those sort of three things that I talked about, actually sales skill, decision making, and some sort of resilience, tenacity, what I start by asking actually is your story and how you got to this point, right? And then how you found the problem, um, and then how you turned finding the problem into building a product. Does it look today like you thought it was going to look like on day one? Rarely. Sometimes, yes, but rarely. And then it's like, well, how did you get from A to B? What was that decision making process in terms of figuring out, well, I could see a problem here. I figured out actually the way to solve it was quite different than the way I first thought, and this is how I do it. That can tell you something about a founder. So I'm asking those questions in the hope that I get something there where it's like, okay, this is as well as being an interesting business, an interesting person to invest in. I think the second half of the question was about what are you looking for if it's in a competitive space. So the thing that you're looking for is differentiation, but not for differentiation's sake, something that matters, right? So you've all heard the phrase like you want something that's a product and not a feature. So if you're in a highly competitive space, what you want is that the differentiation is something that makes all the difference rather than it's something that's nice to have. And then it could be that actually that differentiator really kind of, while it looks very similar, that's actually the thing that matters. And you've kind of got an entirely different product, even though at first glance it looks quite similar. So the other thing is like, actually, how good are your competitors, right? If you're going to be like the better you're, well, I guess it's the better you are at executing, the more chance you've got of getting past a competitive space. And to a certain extent, that's down to you. And to a certain extent, that's just sort of out of your control. How good are your competitors? So you always talk about sort of competing versus incumbents sometimes, right? And it's like, well, they're sort of slow and unwieldy, and that's typically true. And so people like to compete against incumbents. If they're startup incumbents, right, as in they got there 5 years ago and they're in place, they might be unwieldy or they might be able to move fast. It's not clear. And even right now, you're seeing, for example, a Microsoft moving really fast in the AI space, and not only bringing the product on, but literally rolling it across their entire product set. So incumbent doesn't always mean that you'll move slowly, but you're looking in a competitive space, in particularly important, can you out execute?
Okay, and moving on to cap tables. What are the sort of red flags that stand out to you? And also, what stage should founders expect? I guess, like, how far into DD would you expect an investor to ask for your cap table? And I ask that because in our cohorts, we always have founders asking, like, hey, this investor has requested this document. Does this make sense for us to hand it over to them? Especially, something like a cap table, which might be a little bit more sensitive. What are the best practices around that?
So I don't normally ask for that. A lead investor, you can definitely expect to ask for it. The main problem is a long tail of small investors that actually, and the reason it's a problem is because often you have to go out and get investor consent, and it means you have to ask every single one of them. And if you're sat there waiting for those last two people to reply, who you know never reply to your emails, and you're not sure if they're on holiday or what's going on, it can be a massive pain in the backside. So I think my advice would be, wherever possible, if you've got that long tail, it's now quite easy to bring them in via an SPV using an Odin or a Vorban or something like that. Try and do that, and then whoever is kind of head of that syndicate then is the only one that has to make a decision. It's much more easily manageable that way.
That's a good idea. Um, if you were, I know you said you don't typically look at the cap tables, but what would be certain things that concern you, especially around, we've spoken with founders recently who had a co-founder leave the business in the early
Yeah.
days, but pre founders agreement. And so, essentially that was a decent amount of equity that is now not sitting within the company, or with an investor. And so if a founder is in that position, is there chances of raising significantly damaged? How can they expect investors to respond to that?
I think this is going to vary from investor to investor. I think ideally you don't want to see someone with a large shareholding that has no interest in the business. As important is that those that are in the business own enough that they're well incentivized. So I think for me at least that bit is more important, right? And so a red flag could be actually they don't own enough, right? How are they gonna, are they well enough incentivized to actually want to keep building this business in the knowledge that, every round there's going to be some more dilution. So sometimes what you see happen is actually they're awarded some additional share options at the same time to handle that. But what you really want to do is not be in that spot in the first place. And this is one of the reasons why investors often ask for reverse vesting. So it's not just to protect them. It's actually, if you've got co-founders, it protects you if one of your co-founders leaves.
That makes sense. In terms of valuation, what are one thing that we end up hearing a lot from investors, not something that they necessarily shout about on LinkedIn, but when they're in these sessions, here oftentimes they don't actually care that much about valuation at a pre-seed or seed stage. But barring, being a pre-seed, pre-launch, and you're like a 15 million pound valuation, but more the difference between, let's say, like a 2 million and a 2.5 million valuation. What's your thoughts on that? And then what sort of validation do you expect early stage founders to show to you in order to justify their valuation?
So the first thing I just say is, like, valuation is really hard, right? It's hard enough for me sitting here who sees like hundreds of things a year, and then as a founder where you kind of only hear almost the things that are in TechCrunch or sort of over the, which are often the ones that have got the highest valuations because they want to report like what people think are the most interesting ones anyway. Then trying to figure out what your valuation should be is super hard. Um, Valuation does matter, of course it does. Like, so if everything I'd invest in, I invested at twice the pre-money, I would have more loosely half the returns, right? That I would at the end of it. So obviously it does matter, but it's it's just really hard. The way I would look at it is I'll go, well, I invested And the only way you really can look at it is go, well, these are the last kind of 5 things I invested in. I know what valuation I invested in. I know how much I like them, how much I like the founders, how difficult I think it will be to achieve or relatively difficult, and how big the opportunity is. How does it like stack up against those things? So there was another part to your question and I can't remember what it was. Sorry.
I guess like how should founders be prepared to justify their valuation?
So oh, I think that was also what kind of metrics are you looking for? I think that was it. So in terms of justifying your valuation, I mean, a valuation is really just what someone will pay. It's like any market. If people are prepared to pay it, then that's the valuation. So 2021, when those valuations were high, they were still real. People were prepared to pay them. They're a bit lower now. Um, it's I don't. The short answer is I don't have a good answer for that question, I'm afraid. On the metrics, it really depends on your stage, because some businesses you are going to have metrics, and some you're not. Uh, Again, it varies.
Fair enough. Okay, what do the best founders in your experience do differently during their fundraising process?
So I would say start of the process is like find out who you're going to target, right? There are actually a lot of funds out there and a lot of investors out there. It's hard to fundraise even for the very best businesses. You need as many top of funnel things as possible because you're going to get a lot of no's. You want to filter those for I'm giving a much broader answer to the question, but you then want to filter those for people that actually invest in your space as far as you can tell. Then actually it's about how they again, it's about how they tell that story, and then to a certain extent about managing that process. Another thing that I think that founders do well is if they have a meeting, they manage their time well, right? So if they know that they've got half an hour with an investor, don't assume that they'll be able to overrun for 5, 10, like 20 minutes. Sometimes they will, but actually, if you then get to the end of that meeting and you didn't get across those key points that you want to get across and they've got to go, then actually you've missed an opportunity.
That's a really good one. What do you consider to be vanity metrics? And I realize this is difficult because it's going to be different for every business, but we have B2B and B2C SaaS startups in here. So in terms of, I guess SaaS companies as a whole, is there anything that founders over focus on that you don't think is that valuable?
So like, I think most metrics have got some use, but people over qualify on some. So free users sometimes that's really useful because it's top of funnel and you know how many you're going to convert and you know how many you're going to convert them. But sometimes it just doesn't tell you anything because of course people would sign up for free, but would they actually? It doesn't tell you whether someone will pay you for this. And look, there are some great businesses that are out there supported off the back of ads. In fact, some of the biggest businesses in the world, Google, Facebook, I think Amazon now has like a $30 billion a year ad business. It is something crazy like that. But actually, most businesses can't live off free users, despite the fact that some of the biggest in the world actually kind of do. And so sign-ups again, because you just don't know whether they'll convert. Page views is one that is interesting, but again, unless you understand the relationship between users and returning users and how you generate your revenue. And then actually, this is a slightly controversial one. I'm going to say revenue can be slightly a vanity metric because you can have a business with enormous margins, right? Where almost like 99% of your cost of acquisition is tiny or zero, and it's basically free marginal cost to provide. And then like all that revenue is effectively sort of gross profit. Or you can have a business where actually your marketplace, people have booked huge amounts on there, but your margin is tiny and your cost of acquisition means that actually it's not great. So it's not a vanity metric, revenue. It's obviously hugely important, but actually it's often not comparable from one business to another.
I guess like it needs context in order to be meaningful.
Totally. Like on one business, it might be worth 10 times as much as another business, right? And that's why you need exactly that, the context.
Fair enough. And on that note, what's the best way to present that? Like, okay, you've already sent over your pitch deck and now you're in your first and second meeting or third follow-up meeting with an investor, and you have all of these different metrics, some of them important, some of them not as important, and some of them that require more context. How should founders, I think one thing we hear from founders is like they go in with their most important metric, but then the investor actually wants to focus on maybe their revenue or maybe their traffic, maybe their daily active users. So is there best practice around presenting all of that information in a digestible way to investors?
Other than it's different. It's difficult to know because everyone wants different stuff, and you just can't shove everything into a pitch deck. So you need to pick what like your like 1, 2, or 3 sort of KPIs are, and then just if someone else was something different, just have it available for them. And yeah, other people believe different people believe different things are important, and you have to just really go along with that.
In terms of speaking with your users or with your customers, is that something that as an investor you do for startups that you're doing due diligence on? And then also, do you expect the founders to be speaking with the users a lot and getting feedback?
I'll do the second question first. Clear, yes. It's almost like the most important thing, right? You need to understand the pain point that you're solving, make sure that you're actually solving it in the best way possible, because you might think you might think it's a pain point, but it's not a big enough one. You might think you're solving it, but you're not quite solving it. There might be 5 other things that like don't quite work on your onboarding flow or anything that's in there, and you can't find those out without talking to your customers. And again, this then relates back into sort of speed of iteration. You want to be able to iterate really fast on what you do, but you won't be iterating in the right direction unless you've actually spoken to those customers. So if you can do a combination of like really fast iteration and talking to your customers and getting high quality, and potential customers and getting high quality feedback from them, it's again back at that thing I said earlier where you're like, you thought they wanted this is what you originally planned to build on day one, you found out this. It might require 20 or 30 steps to kind of get to that point. The more you're speaking to the customers, the more chance each step is in the right direction, and the faster you iterate, the more steps you can take in a shorter space of time, and the more likely you are to get there. In terms of the sort of DD process, I would say it depends, right? What you're trying to do is figure out as an investor, is there as big a problem to solve, and does anyone else solve it? How do you solve this problem today? So sometimes it's not necessary and sometimes it is. For one business I invested in, for example, I needed to do a client call to get that validation. I did the client call, I recorded it for them. They then shared that with all their other potential investors. And of course, you need the client's permission in order to be able to do this. They shared that with all their potential investors. And actually, at the time, they didn't have a lead. Post the round closing, we all met up for investor drinks. And one of the people from the lead investor said, I feel like I know you already because I've watched that 7 or 8 times. Right, those things can be hugely important, but it really depends on the business. If you've got like a really fast-growing business with kind of low churn, then you can't. You still might like to do a client call and speak to some clients, but you kind of know the product's going to be good and there's a need for it because it's out there in the numbers.
That makes sense. In our program, founders in the weekly updates share how many users or potential users they speak with every week. And one of the things that comes up a lot is if there's feedback around a certain thing that they want to improve, they might not always have the necessary resources or team members to be able to address that. But that also gives them a really good metric to go into fundraising with, saying, hey, we're raising to be able to add these features and hire these people because we know these customers are more likely to convert or, have a higher LTV if we make these amendments. But I mean, hopefully you can do things without having to fundraise, but either way, it will still hopefully be useful in your fundraising journey. Okay, I'm going to ask 2 more questions and then we're going to move straight into questions because we have a lot coming in. What fundraising advice do you have for founders who are pre-seed and they've just launched and they're needing to go into their fundraising process, but they're not really getting the traction that they were hoping to get at the start, which is quite common?
Yeah, so this is a great question, and obviously it's hard, right? There's no doubt that's going to make it a lot harder. So we'll go back to what are investors looking for, right? They're looking for great founders, and they're looking for a business that has the potential to be the sort of venture scale where you're solving a real problem that people are going to pay you lots of money for, right? So what you want to do is, are there other ways that I can evidence that other than just, oh, my business is growing well, so I must have picked a good problem and have something. So the evidence is actually, well, so really go, well, what are the other ways I can evidence that? Well, it's like, well, did you figure out why your traction isn't why it should be? And how did you figure that out, right? And so if you could evidence that actually you've responded in exactly the correct way to that, then actually that can be a proof point. And then on the business, it can be, well, and this is a proof point on both business and founder. It can be, well, we know why we didn't. We figured out it was either onboarding or the problem wasn't the right problem, and we've now, from speaking to our users, figured out this is what it is and this is what we're going to build. Or we did have the problem right, but we weren't solving it in quite the correct way. This is how we found that out, therefore we're going to do X. And so you're like, you then can get to the point, hopefully, where you've got some additional proof points, because actually you ran into trouble and you figured out what the problem was, right? That's actually a stronger proof point on a founder, because every business is going to run into trouble at some point, that actually you dealt with it in the right way. Sorry, I'm in one of those pods. I'm going to have to do this every now and again. So that in many ways, can be a stronger proof point. And then with the business side, it's a bit harder, but you can go, actually, we figured this out, right? We weren't quite there. We are very early. It's a natural part of the process, and we figured this out, and now we know we're on the right path, and this is why we know on the right path. Now, that is still that's an easier message to get across. Look, it's much easier if you've got the traction, for sure, right? It's an easier message to get across once you've got the meeting. How you put that in words in a pitch deck, I think, is a lot more challenging, and I'm afraid I don't have a simple answer for that.
I'm going to skip my last question, just go straight to our founders. The first question is from Leonie. Can a short runway be an issue for you in deciding whether or not to invest in a company?
So I don't think it matters if you've got a short runway now. It's really what the runway will be post raise. That's the important thing. Now doesn't matter.
Okay, Ganesh, let's go to you.
Hi, Mark. Thank you. I am co-founder of an app called Spin, which is a B2C app that connects tennis players together. I was curious, I saw that you are an investor in Runner. Can you give a feel for, if you could boil it down to one thing, what was the thing that helped you invest? Was it growth, or was it team? Just, because B2C apps are a bit not as cool as some AI crazy apps. And also, just if you can potentially, as a part 2, could you give an idea of, in terms of how they've grown, what's helped them? Has it been more SEO, word of mouth, or ads? If you could again pick one, what's helped them grow? That'd be great. Thanks.
So the first point was the growth was great when I met them, and the second point, just to keep it simple, was the founders. I hadn't done any running for about 25 years when I met them. I literally got off the call and wanted to go and buy a pair of running shoes and go out running. And I think that tells you something about the sort of people that are running that business. They weren't trying to persuade me to go and run, but I just really wanted to at the end, and I was able to make a very fast commitment there. In terms of growth, I think they're maybe not a great example, just because actually they haven't really run into, like, they've continued to grow really fast, but they haven't really run into any huge issues. They're able to acquire customers well. They're using partnerships. So they're doing all the kind of standard things that you might imagine, and those things are all working.
So you can't narrow it. You couldn't just pick one that's worked better than something else for a B2C.
I think the main acquisition channel is still, paid advertising. So
Right. Okay, cool. Thank you.
All right. Next question take from the chat. It's from Charlie. Regarding cap tables, if there are a lot of investors, but only a handful have voting rights, is that still a red flag?
I think that helps, right, actually, because that's the problem for me, at least for me. The problem is how difficult is it going to be when you need to go and get approvals. So if the others don't have voting rights, to me, that would solve the problem. Then you've got to be able to persuade people to agree to that, of course.
Perfect. Ajit, I was going to take your question next in the chat, but I see you raising your hand. So hopefully you're going to ask that question.
No, I have a different question. So
that's fine, go for it.
Hi, Mark. So I started with a B2C fintech, and when I spoke to investors, I got a lot of headwind that the cost of customer acquisition is very high, and as such, there is a lot of aversion to B2C fintech in this funding environment. So we pivoted to a B2B2C model, and we are in very early stages of that journey. So in the B2C proposition that I had developed, we already had some traction. We already had the tech built. So do you think in this? So my question has two parts. The first part is, do you think, like, basically, can we show what we have done in the B2C as a B2C as an evidence of what we can accomplish in the B2B2C pursuit? And second part of my question is any top tips that you'd give to as an investor for someone in a similar journey as me who has pivoted from a B2C to a B2B2C space?
So it's really, well, what stage did you get to, right, on the B2C, and then is there anything that you executed it on really well that you can say, actually, this is an evidence point, we're able to build something of this sort in a month, and normally it would have taken 3 months, or this is how we were able to acquire users. We'll take those learnings across to here. We know people like the product, and if for example you had a live product and people like that product, when you're selling B2B2C, you can use that as a proof point to go, we know that users like this and your users will like that. Hopefully, as long as there's a correlation between the demographics.
Yeah, so we have pretty good testimonials from the users who use the product. So maybe you can carry over that.
Yeah, and I think it's, so as long as they're a similar demographic to the ones that you're effectively targeting via B2B2C, then that ought to be helpful. In terms of switching from B2C to B2B2C, that's quite a broad question. I think that the difference is your go-to-market is different, and so the sort of selling mechanism is different, and so it's just a question of giving people the confidence that actually you're able to make whatever those different channels are work.
I see. Thank you.
All right, I'm going to take a question from Tim in the chat. Outside of business essentials, is there a risk that picking the wrong metric too early can lead businesses down the wrong path? If so, is it smarter to measure everything initially? And that's a really good question.
So you can measure everything, but you need to know what's important to you, right? If you don't know what's important to you, then that can or will be a problem. But you need to know why it's important to you, because basically any metric, there'll be a time when it's the wrong metric. If you know why it's important to you, you ought to be able to spot when actually just doing that, without looking at anything else at all is the wrong reason. So really I would pick some metrics that are important to you, but make sure you know why.
All right, Marco, over to you.
Thank you. Hi, Mark. I'm wondering what sort of an impediment is the fact that you have, let's say, a sole founder that took the business quite far. Essentially, we specifically are there's been a long growth from, I was initially a consultant and I started developing this to essentially help myself, and then took it to a full business now, and it's just about to roll out to the market. But there is no big executive team. Is that a problem in a business? And how would you position, if you were pitching in such a situation, like how would you position this and how would you explain?
So just to be clear, is it about, do people like sole founders or don't, or it's broader than that? It's
to what degree it is a problem. Obviously, you prefer having a business with multiple founders, or one, because they complement each other and they will have different skills, and also they can do more things at the same time, right? So my question really is I'm not in that situation, unfortunately. I would like to have a co-founder, but it just never happened. I just want to know how would you advise people like me to address this particular issue, because it always comes up, right? It's always like, okay, so what's your team, and like what's the capabilities, and what are you doing about it?
So my view is slightly different to the normal view. I do believe it's easier with more than one founder. Obviously, if there's 2 of you or there's 3 of you and that you're the right people, you can build more and you can build faster. The counter argument is that actually, if I see 2 businesses at exactly the same stage and they built just as fast as each other, and they only had the founders on board, and one had 2 founders and one had 1 founder, that founder must have actually been way better at executing in order to do that. So I quite like it sometimes if I see a sole founder and I'm like, wow, they've done a lot, that's impressive. And later on their path, actually, you're going to have other people involved. You're going to bring on other people into your business anyway. So at that point, it doesn't really make much difference, other than you're going to have to pay them more. Maybe, founders are always going to work on average harder than other people are. And so it's that challenge rather than actually past a certain point, it doesn't really matter, is really what I'm saying.
Okay, so if you have a good story and a good proposition, that shouldn't be too much of a detriment.
It does depend. There are investors that don't like solo founders.
I've experienced that before. Yeah.
So for me, actually, if 2 businesses look identical and one got there with 1 founder and one got there with 2 founders, that's a greater proof point on that individual founder. You are just less likely to find that, though, because it is genuinely harder to get to that point.
Yeah. Okay. Thank you.
All right. Kabalin, over to you.
Thanks, Sam, and thanks, Mark, for sharing your experience. Cab Gaspard, building Data Posty, a platform that allows businesses to safely share and monetize their data. So, Mark, you mentioned at one point, the challenge of getting people to work for you who really shouldn't be working for you, and that really resonated. Do you have any advice on that?
Again, it's about the storytelling. It's probably closer to fundraising than it is to selling the product, because it is about telling this story and that you want to bring them on a journey, right? Because typically they're going to take a lower salary, they're going to take some equity, and they have to, believe that there's a chance that equity could be worth a huge amount of money in the future. Also, they have to want to work for you, right? It's those 2 things. So again, that really sort of rolls back into that kind of storytelling skill. And obviously, if you've got a business that's already growing and growing nice and fast, it's much easier to do that.
All right.
Thanks, Mark.
Katrina, you're next.
Yes, hi. Thanks very much for your time today. Katrina Prentice, Carly Street, Africa, taking AI and telemedicine into Africa. You may, so I clicked out a little bit with the last speaker, preparing my own, so you might have answered it already. But how do you incentivize workers? Everybody seems to want a piece of my business at this point in terms of working. What do you do there? And conversely, if somebody's been in my business working quite hard, but I can see that I need to shift gears into a different direction and perhaps not be utilizing them as much as they have, do I pay them? They still want equity in my business, and I don't know how much to give away. I don't want to give anything away right now. And finally, one question, but very important to all of us, I'm sure. What if your partner, your business partner, hasn't got the skills that is required right now? I think I heard about a year ago that there's a legal term where you have to earn your shares as a founder. Does that make sense? So you, my business partner is sort of 50-50 in his own mind, but that's fine, it's in his mind. But he can't bail out in 6 months' time, having done 199% of the work with me, having done 99% of the work right now. So the question is that right, that they'll have to, everybody earns their shares, including me, by the way?
So the first answer on incentives is actually you want people to be incentivized well, right? So
no, not really. I do want them
you should want them to be incentivized well.
Yes.
And actually the best way to incentivize people is to give them equity and for them to believe that that's going to be worth something in the future.
Yes.
If you take VC money, your lead will most likely insist that you have a pool of equity options that you give to your employees because they want them to be incentivized well. So I think that you've got kind of a mental hurdle that you need to get.
No, I got that wrong. So yes, I'm happy to give them equity. Sorry.
Yep.
I'm happy to give them equity, but a third of my business, I don't think so.
No, so that's definitely too much. And often you have a 10% options pool. Sometimes you add another, it can be a new options pool on every single investment round, right? So it can add up over time, but you know, if you get through multiple investment rounds, you're going to get diluted anyway. But typically what they should want is they go, well, I'm prepared to take a lower salary plus equity because I believe that's going to be worth something. So the term that you were thinking of was reverse vesting, which is what you do for founders. And typically you get like what normal looks like is reverse vesting over 4 years with a 1-year cliff. That means you don't get anything. This is typically how it will be done for founders. Unless you've been there for at least a year, you don't get anything. And then it might be monthly or quarterly, the rest of it. And then you'll get, let's say, a quarter of it. That can happen again and restart after every investment round, right? Because the investors want to know that actually you're still going to be there for the long term each time. So and for individuals, if they're given share options, again, there is typically a vesting schedule. It might look a little bit different, but typically you have that, so you don't get them if you're given an options package and you leave 6 months later, you might not get anything. So
very good. Thank you very much.
All right, Mike and Cal, you're next.
Hi, thanks so much, Mark. Really nice conversation, really nice advices. Also content on LinkedIn, I'll allow myself to have a quick look, really resonates with me. Quick question, in terms of your the 3-minute pitch, which I'm definitely submitting to you soon, what is your typical acceptance rate? Just in case I'm not going to be accepted and I don't want to feel too bad about it.
So I would say it varies. And it varies depending on how busy my diary is, and obviously that's kind of out of your control. And if my diary is like on the emptier side, then you've just got a much higher chance of getting through. And if it's on the lowest, if there's not much free, then it might be quite difficult to get past it. So I think there are some vagaries that are out of your control. And whether you do or you don't get through, and I hope you do, then I'll give you feedback at any point on why that was.
So if I can only carry on, when is your diary more free? Soon?
Well, that again, it's hard to tell ahead of time, right? Because sometimes it's empty and it stays empty, and sometimes it fills up fast. So that I'm afraid is a bit of potluck.
That's right. Cool. Thanks so much. Thank you.
Love your boldness, Mikhail. Okay, quick question from the chat. This is from Ina. What are the expectations of investors for advisors and advisors/angels who sit on the board? Are there any specific guidelines or rules to follow?
So the short answer is no, there aren't any. I would be nervous about investors that say they'll only invest well, apart from lead investors, if they also get, let's say, advisor shares, or get a paid board seat alongside it. But apart from that, I don't really have any guidelines. You want people that want to invest in you because they want to invest in you. Then if you think they're worth having on your board, or they're worth paying as advisors, that's great. But they shouldn't be trying to roll those two things up into one.
All right. And Mark has to leave a few minutes early, so we're going to take one or two more questions. Akoli, you're next. Akoli, can you hear us? Okay, I'll message him. In the meantime, do you want to ask your question, Tim? You're on mute. Or Tim, you're on mute.
Apologies for that. Mark, it's on reverse vesting, and it's probably a technical question. If let's say you invested in my business and it was going great, and as happens in the food and restaurant tech space, somebody terribly big came along and wanted to write a very big check during a vesting process, or when I theoretically don't have any shares. What happens then? Is there a point at exit where even during a vesting process, the exit resolves that vesting, or would I just lose out if you decided that as a your vote, or the vote's carried to exit? Does that make sense?
Yeah, it does. Typically, if you have an exit, everything vests, basically.
Yeah. Cool. Thank you very much.
That was
all
easy.
Right. Do we have any last questions?
I do have another few minutes if there's if there are a few more questions. So I know I need to leave early, but not this much early, so that's okay.
I think there's a question from Ajik, if I may suggest, from the chat, because that's something I would be interested in as well.
Go for it. I saw, Ajit, if you want to come back on, I saw 3 or 4 questions from you, and I wasn't sure how much of that you felt was covered when you asked the question live. But if you want to expand on any of the questions that you asked, if you want to take yourself on mute and ask them, go for it. If not, I'll read one of them right now, and then Guy, I'll go over to you.
Yeah, I can ask one of the questions. So in B2B, since the sales cycles are quite long, and it could be that would be meeting several decision makers within the same company, and that could be going on in parallel with few other companies, without them giving any commitment that, okay, we'll do a beta with you, or we'll onboard your product or something like that. So while those things are going on, how do we show traction to an investor that things are happening, but nothing is confirmed yet?
So I think there's 2 answers here. One is that actually what you want to have is a funnel, and understand kind of what the steps are in that funnel, where I do this much cold outreach, it leads to this much first phone calls, it leads to this much first meeting, this much I've now met a decision maker. And over time, it's obviously hard to do at the beginning, but over time you'll start to understand what that process looks like, and what sort of success rates you should expect at each stage, and how you can optimize all those pieces. The other part is actually, until any of those things have closed, it's really hard with investors, right? And the reason it's hard with investors is because it's hard for me to tell, right, what's real and what isn't real. A story you often hear is, we've got this great pipeline, in 3 or 6 months we're going to have all these contracts and this much revenue. It's a very common story. It's really hard to tell when it's real and when it isn't real. And by not real, I don't mean that the founder doesn't believe it or is being dishonest, and that's not what I mean at all, but how often it's actually going to happen, and the likelihood those things are to convert. So again, it can be we explain how you've understood the problem and how you've understood the market, and actually, can one of those potential clients, can you do a potential client call, right? And again, those things are hard because they're enterprise customers, you don't want to piss them off. But if there's one that you get on with well, where they can say, this is where we've got to on the process, this is a real need for us, this is why we're strongly considering you, then that goes a long way.
Okay, and will it be possible to take a video recording of that and use it with other investors if I'm doing a wrong?
So
I mean,
as I say, and I've done that, but you need to have
Yeah.
an investor that is prepared to be recorded and shared, and the harder problem, have a potential client that is happy to have it recorded and shared. So as I said, I've done it, but you need to find the right people.
right.
Okay, I'm going to jump to Edward. Edward, I missed your question in the chat. So if you want to go ahead and ask it live now, go for it.
No, I'll switch my question. I'll ask an easy one. So there was a point at London Tech Week yesterday. A guy got on stage and he said, basically, properly funded VC firms, 3% probability of a decent exit, 7% probability if you put together a good board, and 20% probability of something if you actually sold beyond your continent. So he was talking about kind of two things that really made a difference. One was you put together a quality board. Two was you actually managed to export, so you crossed your own borders. So the question for you, Mark, is around boards. As a VC, do you care and do you help? You know, obviously causation is and correlation and all that fun stuff, but is it a thing? Is it a thing you think about that makes a difference at kind of early stage?
So the ability to go into other continents, yes, right. So if you can see even at a relatively early stage that they've got a good proportion of clients outside of the UK, that's just, if you think about it in terms of total addressable market, you've already evidenced that actually the market size is bigger and you can sell into those other markets despite there potentially being cultural differences. In terms of the board, I don't see it as strongly as that. A good board is helpful, but they're not unlikely to be the thing that makes you succeed. A bad board, and I have seen them, can be very unhelpful and make things significantly harder. You know, a lead investor that I've invested alongside, they asked him, you know, what's the thing you've done for like your best founders to help them the most, and his answer was get out of the way, right? So for the very best businesses, yes, you want to be there and be able to help them and support them when they need it, but actually the best ones probably don't need it that often.
No, that was my instinct. That's why I was asking the question, because I thought I agree, right? Exporting makes total sense. To me, over reliance on the board didn't seem like a massive value, but he was definitely pitching that on stage.
Yeah, it's like, you know, advisors, if they're good, you want an advisor that you want to call upon because it's useful, right? You might want to have a coach that you call upon, right? Those things are all helpful, but they shouldn't be the be all and end all. And the doubling the chance of successful outcome is, I think, unlikely for me.
Okay, do we have time for one more, hopefully very quick question? Okay, Guy, do you want to ask yours?
Yeah, so our issue is we've been around for a few years and we've kind of pivoted a lot. We've spent a lot of money. It's taken us a lot of time to figure out what we actually were. We started as an Uber for law, and then we decided to be a practice management system for law firms. And now we've kind of settled on being more like a Slack for law. And I think a lot of investors look at us and they worry that, yeah, we don't have the ability to execute, even though we've won some pretty high profile customers now. We're making some money, which is, you know, an achievement, I guess. So I want to understand, you know, is this a red flag that we'll never get past? And should I just shut down the company and find new co-founders and start something fresh? Which I think could also be unethical if I land up doing something quite similar. Or do I keep going, you know, with my business? And if so, how should I treat this conversation when I do chat to investors? Do I sort of air out all the laundry right at the beginning, or you know, how can I craft this into a compelling narrative? We've raised about $350,000 so far. We spent the money to get where we are, and yeah, that's my question. So it makes sense.
So, in terms of should you like just go start again, I have no idea, right? I really don't have enough information about your business to answer that. I think I wouldn't start by talking about those things because it will just get in the way of the story that you want to tell. You start by talking about where we are now you have to have that information in there somewhere. Maybe you have it in an appendix, but you have to go, this is the story now. And then hopefully how you got there, some of those things will be proof points. We figured we weren't in the right place. We figured it out. The concerns can be around, do you still own enough, right? Maybe you do need to do a recap, right? Where you go, actually, we need to make sure that the founders own some more. So they have to be given some more shares or share options at the next round. And the
that was actually an idea of mine, was to maybe bring on a couple new co-founders, create sort of 20-30% of brand new shares, so that we, the co-founders, not necessarily me, but we collectively have a bigger share. What do you think of that?
So how you do it, I don't know, but you need to make sure that you own enough, and the investors will want to make sure that you own enough. The other challenge can be around valuation, because if it's like, oh, well, we have to keep it higher to keep the existing investors happy, that may put you at a valuation spot where actually it's hard to raise money. And it would be a question it would make me give more scrutiny to the valuation when I see something like that, because I know that's going to be pressure from existing investors. So it might be a case of, we need to go in at a sensible valuation. We need to add additional shares for the existing founders or new founders. We might have lost you, Guy, but I'm going to keep answering. Oh, there you are. I'm going to keep answering anyway. And as a result,
that's really, really helpful. Thank you so much.
And as a result, those existing investors may well get squeezed out a bit, right? Which is an effective recap, right? But just that's the only way to do it.
Okay, with that, Mark, I don't want to make you late to your 2:30 call, so we will say a big thank you, and we can stop the recording and we'll wave goodbye. Founders, stick around for just a moment.
I just want to say one thing. If you want to connect with me on LinkedIn, just send me a connection request and say that you were on this, because I don't normally accept random ones. But if you say, hi, I was on the call, then I'd love to connect with you. So
you're about to get a massive influx of LinkedIn requests. Perfect. Thanks, Mark.
Cheers. Thank you.
Yes.
Bye-bye.
Okay.